investor sentiment is a belief about future cash flows and investment risk that is not justified of facts at hand. And then we have this definition, and then we need a logic to relate this definition with stock price, especially cross-sectional variations in stock return. Cross-sectional means like a day, suppose there are thousands of stocks, and a day some stock goes up and some stock goes down, and some stocks go up a lot and some stock may go down a lot. So stock returns are different across stock per day, every week, every month. This is called cross-sectional differences of the stock return. At some particular moment, some stock goes up a lot and some stock don't go a lot, something like that. Cross-sectional differences. And then we need a logic to relate this definition of investor sentiment and then that cross-sectional differences in stock return. Okay, otherwise you cannot basically generate trading profit. If there is a cross-sectional differences, and if we can somehow predict that cross-sectional differences, we can take a long position on the stock that is likely to go up and take the short position, like a selling position on the stock that is likely to go down. Then you can generate trading profit. So what would be the logic between this definition and then cross-sectional differences? Well, there are two channels. One is sentiment-based demand shocks. So investor sentiment affects stock return differently, cross-sectionally differently, because of this sentiment-based demand shock. Some stocks are more subjectively valued than the others. Okay, like a subjective value. So, and then we can argue that subjective valuation is more likely to be influenced by speculative demands, which is in turn originated from investor confidence and emotion, i.e. investor sentiment. So there is a basically cross-sectional differences in the valuation of stocks. Some are more subjectively valued and some are more objectively valued. And then if there is a shock, then those stocks with subjective valuation will respond more, right? If there is a positive sentiment shock, for example, then they will go up more. If there is a negative sentiment shock, then they may will go down further, something like that. And that will generate cross-sectional differences, right? Does it make sense? Yeah, there is one channel, but then we need another channel, which is called the limits to arbitrage. Suppose there is a sentiment shock, and then stocks with subjective valuation maybe goes a lot, okay? And suppose there is a negative sentiment shock, and then stock with subjective valuation will go down a lot. Then, well, if we are smart enough, and if we are rational, we don't have to be smart. If we are rational, then those stocks that responded to the sentiment, well, maybe we can take the opposite position, right? If there is a positive sentiment shock and those stock prices go up, well, then we can expect that those stock prices will go down later on, converge to fair price, right? Anyway, sentiment doesn't last forever. We all know sentiments are temporary. You know, even love is temporary, right? Of course, some people love each other forever in their entire life, but that is, statistically speaking, that is not like they are actually outliers. Sadly speaking, they are outliers. So even love is changing temporarily, and other sentiments are even more temporary. Right? Therefore, if we believe sentiment is temporary, then those stocks that responded to sentiment will converge to their fair price anyway. Then therefore we can think through that process, and then we can take opposite position and we want to make money. And then if everyone wants to that kind of transaction, then even if some stock price deviate from fair price because of emotion, then they will instantly go back to their original level, right? Then we need a mechanism to prevent that. Then what is that? It is limits to arbitrage. Some stocks are very difficult to trade. Especially some stocks are very difficult to take a short position, take a selling position. It is very hard. If some stocks are, and then some stocks are actually easy to do, limits easy to do arbitrage transaction, easy to trade. Then even if there is a sentiment shock and there is a cross-sectional differences because of the subjective objective valuation, that cross-sectional differences can remain some time. Okay, they may go away instantly. They may stay as they are for some time because of the limits to arbitrage. Right? Then if we combine these two, then we can generate cross-sectional. So by combining these two, maybe then we can generate cross-sectional difference in stock return, which is significant for some time, which again imply trading opportunities. Any question? Yeah. So does it make sense? So anyway, these two channels, sentiment-based demand shock and limits arbitrage, they are the two channels that economists identified how sentiment can affect stock return, especially cross-sectional difference in stock return. So they are only two, okay? They are only two. And I think there may be other channels possibly. Besides these two, there are possibly other channels through which sentiment affects stock price. I don't know it, but I don't think these two are comprehensive list of the channel. So do you have any idea? Can you come up with any other channel besides these two? Can you come up with any other channel how sentiment can affect stock return, basically? No? When you think about it, of course, it is a hard question, and if economists has idea about the channel beside these two, they may have written a paper already. They didn't do it, which means that it is very hard to find another channel. But still, I don't think they are the complete list. And then another interesting thing is that this sentiment-based demand shocks, which relate with the degree of subjective valuation and objective valuation, and this limit to arbitrage, they looks like the two different separate channels, but in reality, they are highly related with each other. So in the end, they are simply just one channel, which is not satisfactory, but they are basically just one channel. Because suppose there is a stock which is very subjectively valued, therefore it is very susceptible to investment sentiment shock. Then those stocks are also likely to the stock with limits to arbitrage. For example, like a very small stock so that major stock analysts in major investment don't follow. Suppose there are small neglected stock. And because people are not that interested in those stocks, maybe those stocks are likely to be subjectively valued, right? And in addition, since those stocks, people are not that interested in those stocks, therefore people are not likely to trade that stock a lot, which means that it is also maybe difficult to trade, and then therefore there are a lot of limits to arbitrage. Right? So they look like two different channels, but in reality, they overlap a lot. I don't think they 100% overlap, but if some stock belongs to this, and they are likely to belong here as well. So therefore, we can make this kind of graph. So suppose there are like 1,000 stocks. Let's assume there is 1,000 stocks. And then let's make that 1,000 stocks into 10 groups, 100 stocks each, based on the score of these two, sentiment-based demand shock or extent of subjective valuation, and then limits to arbitrary. Again, I told you they are highly correlated to each other, right? So if we have 1,000 stocks, then based on those scores, we can make categorize stocks 100 each, 10 group, and then in the 10 group, let's call number 1 group as the safe, easy to arbitrary stock. So when safe, easy to arbitrary, which means that they are objective valued and they are easy to trade. So they have low score on this one and this one. Let's say they are first group of stock, and second group stocks are slightly more subject to subjective valuation and slightly more difficult trade. And then we group them 100, 100 each. And the last group, the 10th group, is, let's say, they are very subject to demand, which means that they are very likely to be valued subjectively. And then they are also very hard to trade, like a very small stock, something like that. Okay? Again, so we can sort the stock into 10 groups based on these two scores. Okay. Then what we can conjecture is that suppose this P star is a fair valuation. So suppose there is no demand shock, and then stocks are at their fair valuation. And then if there is high sentiment, great positive sentiment, then it means that this graph, what this graph says, what this graph is saying is under high sentiment shock, safe, easy to arbitrage shock stocks are undervalued slightly, and then speculative, difficult to arbitrage stocks are overvalued, right? Like this. So undervalued, overvalued. And then if there is a low sentiment shock, then safe, easy to arbitrage shocks are slightly overvalued, and those speculative, difficult arbitrage shocks are largely undervalued. So there are two interesting patterns, like depending on sentiment shock, like they are tilted in this way, and there is more tilt in the, so these stocks are fluctuate more depending on sentiment shock than these stocks. It may seem obvious, but can someone summarize why is that? Why would stocks, 10 groups of stocks will respond this way? Laura, do you want to try? No? Why? Okay. Victor, do you want to try?
Respond in what way? What was the example?
So, okay, let me explain more. It's a theoretical effect of investor sentiment on different types of stock. So, do you understand? Do you think you can understand this x-axis? Yeah, 10 group. And suppose there is sentiment, high sentiment shock. Then this graph means that on the high sentiment shock, then this value looks like this. So they are undervalued and they are overvalued. And if there is low sentiment shock, what they say is that now they are overvalued and they are undervalued. Why is that?
Well, if there's a high sentiment, it means that they're easy to predict. That would be the idea. So the other way around. I'm not sure what you want me to say.
Okay, that's a good start. Yeah. Any other suggestion? right? That's kind of supply and demand thing. Yes, good point. Yeah. And then can someone give more specific explanation? That is clearly good start. Can someone make a complementary argument about that? Can someone add some thought about this? Maybe it's maybe too obvious. So suppose there are high sentiment. High sentiment, how can I say? High sentiment means, let's say there is a good mood. Okay, everyone feels somehow good. Okay, and then if people somehow feel good, then okay, let me rephrase question some other way. Suppose there is a casino. Okay, casino in the town, so you can do the gamble. Okay, then please guess. When do you think we'll visit that casino more? When people are happy or unhappy? Yeah, happy. Why? Why people visit casino and do gamble more when they feel happy or feel high, in good mood? Why is that? Oh, beg your pardon? They don't care about losing because they are happy. Yeah, happy. Yep. They have much more confidence. Good, very good point. Any other point? Yeah. I think you are all right. I think that's true. When you are feel happy, maybe you wanna visit casino because now you are more willing to take risk. You are happy enough, so now I can take risk, and I'm become confident, something like that, right? So if you wanna take more risk, then you visit casino. When you become unhappy, then well, maybe some people go to casino when they are unhappy, but when they are unhappy and depressed, and they are not in the mood to take more risk, something like that, right? So when people are happy, and happiness is not exactly, it is just one component, high sentiment, but when people feel high, okay, when people feel high, well, they are in the mood, more in mood to take risk or become confident. So they are maybe more willing to take risk in small stock, like speculative, difficult arbitrage. So this is like risky casino. So when people go to this casino, right, speculative, difficult to arbitrary stock. Well, then when people visit casino a lot, then casino should make a lot of more money, right? Something like that. So people flock to this speculative to arbitrary stock in good mood, then we can guess that those price of those stock will go up, right? But then on the other hand, people are less people because people go to the casino here, and then people are less interested in those boring stocks, right? So they are slightly undervalued. Therefore, when people in high sentiment stock price valuation like this, so they are overvalued and they're undervalued, right? Well, and then when people feel low, when people are in low sentiment, then the opposite should happen, right? And then people don't go to casino. Right? They don't want to take risk, so they don't bother to look at speculative, difficult arbitrary stock. So they are like undervalued. And then instead, relatively, though people are, if they invest at all, they should invest only on this stock. So they are slightly overvalued. Right? Does it make sense? Yeah? Does it make sense? Okay, so this is our theory. There's a theoretical effect. So if we want to test this theory, what we should do? How do you think we can test this theory? Like this? Different? Oh, I mean, it is just so. So that's a good point. So depending on high and low sentiment, the slope may be different. In this case, they just draw it in the same slope. But right, depending on, with the same positive and same negative shock, maybe slope of this is maybe bigger or smaller, something like that. And that is a good question because I found in Korean market, at least in Korean market, I found the slope of this one is steeper. When people are in high sentiment, where there is a overvaluation on this one, undervaluation on this one. But when there is a negative sentiment shock, this becomes even, right? This low sentiment shock becomes even more steeper like this. So there is asymmetry. I believe there is asymmetry between this response and this response. So good question. But this is just illustration. Okay. And I think that is a good, promising research topic. Okay. And another thing is we have just high sentiment and low sentiment. That's very vague. There's no such high sentiment and low sentiment. Sentiment, there is more specific sentiment in reality, like sadness, happiness, fear, right? Sentiment is like a complex thing, right? Sentiment is a combination of a lot of more basic sentiment. So depending on those basic sentiment, they may respond all in different way. Okay? And there is another good research question, and people don't have much idea about that either. But anyway, this is just the illustration. So my question is again, how do you think we can test this prediction? Again, this is just, this sounds logical, it sounds plausible, but still it is theory. We have to test this one. Do you have any thought how we can test this one? If we rephrase this question becomes how we can make money out of this theoretical prediction. Okay. If this theory is right, and if we build some trading strategy based on this theory, we should be able to make money. All right? That's another way of saying then how to test this theory. Okay. Any suggestion? Yes. Okay, good idea. Any other idea? How we can make money out of this one? That's clearly a good start. And let's follow Kyungjin's idea. Okay, then what we can do is first we need two things. First, we have to identify for each stock, we have to measure extent of subjective value and extent of limits to arbitrage. Okay, we measure these two things in each stock. Then we sort stock from the lowest score to highest score. So we have a sort based on score. Then we measure investor sentiment, and then we generate investor sentiment, and we observe investor sentiment. And then what we can do is when there is a high sentiment, we buy. When there is high sentiment, which stock we have to buy? This stock or that stock? When there is high sentiment. When there is high sentiment, do we have to buy this one or this one? Safe one, speculative one. Safe one, right? Because it is undervalued. And again, sentiment change, right? So what we can do is we buy this one and sell this one because our theory tells is that these stocks are undervalued and these stocks are overvalued. And if that theory is right, as temporary change, this stock price go up, this stock price go down, and therefore we should be able to make money, right? And then on the other end, when there is a low sentiment, well, we can do the other side. We buy now risky, speculative stocks, and we sell safe and boring stocks. And then for some time later, we should be able to make money. So if we can make money, our theory is right. If we cannot make money, our theory is something wrong. There is something wrong with our theory. Right? Okay. that's the basic idea. Okay, so we can test it. But then, yeah, which means that BW's reasoning suggests that investor sentiment can have a larger effect in asset pricing at some countries than others. Like, skip this one. Okay, and I think this is important. Okay, and then first, this part is easy. There are many ways, I think, to classify those stocks from the safe, easy to arbitrary stock to the speculative, difficult arbitrary stock. Well, let's assume that part is easy. And in fact, that part is not that difficult. The more difficult part is we have to somehow develop a way to measure investor sentiment. That part is more tricky and difficult. And then, again, as I explained, there is a direct way of measuring it. There is an indirect way of measuring it. I mean, direct way of measuring is a bottom-up approach. We ask each people, do you feel high? Do you feel low? Something like this, okay? Each people, are you happy, unhappy? Right? That's maybe the best way, right? To measure people, whether people feel high or low. Ask directly. But then there is, again, impractical, right? We want to make money, and then whenever we want to make money, how many people should we ask? I mean, that is time-consuming, and that is expensive. So that is maybe not practical. Some people find a smart way to do that, okay? Like this, there are lists. There are some smart way, and now people call this age is like big data, right? And using some sort of big data technology, there are entrepreneurs out there. They use big data technology, and they actually measure sentiment of the people and use that data in order to generate marketing strategy and possibly financial strategy like that. So anyway, there is other. And more easier way possible is like top-down approach. We measure investor sentiment somehow indirectly. That is more like to be wrong, right? Because it's indirect way. But maybe that would be easier. And then depending on our method, maybe we can, in this paper, let's use only indirect way. Okay? For the time, let's take an indirect way of measuring investor sentiment. So let's think about it. Okay, let's think about it. What do you think would be, so let's assume we cannot ask people directly whether they feel high or low. Well, maybe that is not good question. Maybe people then assume that it is like some drug problem, something like that. But anyway, let's assume that it is not possible to ask people directly, okay, whether they are happy or not. Then we have to come up with an indirect way. And do you have any suggestion how we can indirectly capture people's sentiment? Any suggestion? Do you have any creative idea how we can measure investor sentiment indirectly without asking them? Yeah.
I think if the sum of the investor make money,
Yeah.
the sum of the money that investors make
Yeah.
gets bigger,
Yes.
I think the whole sentiment will be positive.
Really. If you see your enemy make a lot of money, do you think you feel happy?
No. The sum of the sentiment will grow, increase.
Okay.
Many of the investors make money, and then many of the people will be happy. Some of them will not be happy.
Okay, so we can observe that whether people make money or not, and then you mean when people make money, they are happy, and people somehow, okay. So basically, we can check the people's income flow, something like that. Okay. Well, so your argument is that basically money can buy happiness. Okay, that makes sense. Yeah, Heiko.
Maybe if a lot of investments are made, you can see that the investors expect good economic future. Maybe you can measure that
That's a good question, very good suggestion. But can you be more specific how we can do that? What kind of data should we look at?
I think nowadays they expect, or they expect that the US dollar
Uh-huh.
will become stronger.
Uh-huh.
And you can measure it because more and more people invest in this currency. And on the other hand, a lot of people bet against the euro.
Okay.
So you can maybe expect what will happen in the future and what is expected.
Okay, maybe I didn't understand your answer correctly, but I think that's a very good point. I never thought about it because when global investors feel fear, feel very uncertain about it, what they usually do is they buy dollar. It is called the flock to quality. Yeah, flock to quality. They flock to dollar because they believe dollar is a safe haven. So by keeping track of global investors' buying behavior on dollar or selling behavior dollar, maybe you can indirectly capture the sentiment of global investors. We can measure sentiment in global scale. That's, I think, a very good suggestion. Yeah, I never thought about it. That's a good idea. So, yeah. Gold. That is another good suggestion. Well, that's a good idea. Yeah. That's a good suggestion. Yeah. We check dollar and gold like a safe asset. We generate list of the safe asset, and then we keep track of global investor buying behavior and those things. And when they buy a lot, then we can say, well, people are like feel low because of the fear. And then when they buy some like risk cash, risk currency, something like emerging market currency, or more like speculative commodities, then maybe we can say people are in the mood for gamble, something like that. That's a good suggestion. Okay. So any other suggestion? Yeah. Yeah, but thing is that we want to, so if we narrow down our scope into the stock, we want some cross-sectional variation in stock, which means that when there is a shock in the Korean stock market and the Korean stock market index go up, it is like a level. Everything go up together, or everything go up down together. So it is not like exactly what we want. And another thing is that well, stock price can go up and go down. And the thing is that, okay, there is like a cause and effect thing, okay? Stock market is where we want to trade. We want to know undervaluation and overvaluation in the stock market. And then by just looking at whether stock price go up and go down in stock market, it does not logically right. I don't think it is that logically sound generating trading strategy in the stock market. Right? Do you know what I'm saying? So we need some information somewhere from other source, right? Because we want to trade in stock market. We want to know overvaluation, undervaluation in stock market, right? Therefore, looking at those stock market and saying the stock market is go up, it means that they're likely to overvalue. It is like a tautology, right? So we need this information from some other source. So any other, so like a dollar and gold price, that is also financial asset, but they are not stock market. So they are information from somewhere else. Any other thought? So anyway, what economists did is similar to Heiko's idea, not exactly dollar and gold, but the underlying logic is very similar. What they did is that this one. Okay? They basically brainstorm. Okay? brainstorm list of the economic data, economic variable that is likely to be somehow related to sentiment, like dollar and gold price. Dollar and gold price move a lot because of many reasons. Maybe interest rate policy of European Central Bank, or maybe war in the Middle East. Many things affect dollar and gold price. And investor sentiment can be the part of that causes, part of the reason why they move around, right? So, okay, but anyway, stock and gold price, gold and dollar price may not perfectly correlate with the investor sentiment, but possibly somehow correlate with the investor sentiment. And we can keep doing that. We can find another kind of data that is likely to be related. It doesn't have to be perfectly related. May contain some information about investor sentiment. And they are the list that economists come up with. Okay, so we can discuss it one by one. Okay, so suppose now we have a list, dollar price, like a gold price, and list of other variables. Let's say there are like 20 lists of the index that is likely to be, they are indirectly related to investor sentiment. Okay, we have like 20 of them. Next, out of the 20, how we can combine the information of 20, okay? In the end, we want just one index, right? One index that captures investor sentiment, not 20. So you have to somehow summarize those 20 indexes like this, or like a dollar, gold, and those things. How we can do that? Do you have any thought? One idea is just take the average of the 20, right? But then maybe there is an idea. Wouldn't be there more smart idea to just take average of those 20 information? One average is a good idea, but thing is that if we take average, I mean some indexes are more closely related to sentiment than the others, right? Possibly. So just taking the average is maybe not the smart idea. We want to take some logically, we want to take some weighted average, such that we want to give more weight to the index that is more strongly correlated with sentiment and in others, something like that, right? Yeah. Okay, so how we can measure the sensitivity? That's the key part, right? So if suppose we have a 20 index and some index are more sensitive to the underlying investor sentiment, then we want to give more weight to that. But then problem is that we don't know the investor sentiment. That's what we want to measure from the beginning, right? Therefore, since we cannot measure investor sentiment, we are using indirect. We are just collecting the correlated one. Therefore, since we don't have investor sentiment yet, that's something we have to construct. Therefore, we cannot measure the sensitivity between sentiment and those individual information. Well, we cannot do that currently. But that captures an idea how to do that. But that is not I'm not saying that it is wrong. They are not correct, but not entirely wrong. Okay. Anyway, any other thought? So, okay, we need a weighted average, and then weight should be related to the sensitivity of underlying investor sentiment. But still, we don't have underlying sentiment. Okay, but there we have good hint at this stage. Okay. Any other thought?
Some surveys.
Survey? What survey?
So
there is a hybrid method of a direct way and indirect way. Okay, that's another suggestion. Maybe we can combine. So currently we are focusing on indirectly measuring investor sentiment, but what we are suggesting is that we are asking people somehow to determine the weight of those things. There is a hybrid of direct and indirect way. Any other thought about measuring the sentiment indirectly by combining those series of information? Okay, the idea is like this. Okay, we definitely there are suppose 20 series. We have to take weighted average. Okay, that's one idea. And then problem is how to determine the weight. When we determine the weight, again we want to give more weight to the index that is likely to be strongly correlated with the sentiment. The more strongly correlated with investor sentiment, which means the more sensitively they respond, we want assign more weight to that, right? And that is the difficult part. One idea is that we can check correlation between those indexes. So if there are 20 indexes and we want to check like a correlation between the two, so like we have like 20 by 20 correlation matrix, something like that, right? And if we look at, so using that correlation matrix somehow, if some index is more likely to be strongly correlated with the others, then we should want to give more weight to that, right? Because if one of the indexes are more strongly correlated with the others, and they may capture that information, capture common fact, common component of each indexes, right? And then from our conjecture, there are all the list of the indexes that are likely to be correlated with investor sentiment. So if there is some sort of common component, that should be the investor sentiment, right? So if we can find an index that is more strongly correlated to others, each other, one strong one, then that is likely to receive a higher weight, right? Do you understand what I'm saying? Right? So we can, there are 20 by 20 matrix, which is correlated by each other, and we are trying to find the index that is correlated with each other more strongly than the others. They are maybe center of the hub of the relationship. They are maybe the strong one, okay? Strongly, like a center of the hub, okay? Center of the network, some sort of, right? And then we can generalize that approach. Okay, maybe we can combine one index and another and combine the two, and that combination are actually in the more center, more related than individual index more, then we want to give the combination of two more weight, something like that, right? And you can doing that, okay? It is very difficult to do it by hand or by eyeballing the variance covariance material, but we can write computer program, numerical procedure to find extended correlation of each other and find the strongly correlated one. Okay. The numerical routine, numerical way of doing that. If you are good at, have anyone take linear algebra before? Linear algebra, or you took linear algebra. If you take linear algebra class, there is a method called eigenvalue decomposition. Okay, in matrix there is a value called eigenvalue. And then by doing that eigenvalue decomposition, we can find the strong component. Okay. So anyway, there is a mathematical technique. There is a eigenvalue decomposition 1, and that is called principal component analysis. Here. And the another approach is Kalman filter approach. The common thing, this principal component analysis and Kalman filter approach, what they are doing is that, again, out of the 20 indexes, we find underlying hidden component that generate core movement of everyone. In the, of course, those 20 indexes, when some goes up, maybe some go down. Some go up, some go down. They are not perfectly correlated with each other. But thing is that if there is some common underlying unobservable factor that drive a common movement of them all, then it should be the investor sentiment, because we are collecting the data which are likely to be related to investor sentiment, right? So anyway, there is a mathematical technique of doing that, and that is not difficult. In the like a statistics program, you can just write down one line, principal component, and then just plug variance covariance matrix, and you can get the answer. That's a very simple one. But the idea is like that. We find common component, some unobservable component that drive core movement of everything. It's called principal component analysis and Kalman filter. So what economists did is that in the paper I am introducing, okay, we collect these 20 stocks, and then we find variance covariance matrix, and then plug the principal component analysis, and then from the principal component analysis, we generate one information, one index, and we can call that index as a sentiment. Done. Simple, right? That is very technical part. And the next question, of course, what 20 indexes? HYCO is a good idea, like gold price and dollar price. And economists has other one. Like first one is growth rate of number of listed companies in the stock market, in Korean stock market, in my case. Why do you think? So the idea is like that, like this. In Korean market, there is like, let's say there are 10,000 number of firms are traded. But yesterday, there was 9,000 companies were traded. So from yesterday to today, we have now, maybe because of IPO of those things, we have more companies are now traded in the market. Do you think it is the, why do you think that it is related to investor sentiment? If there are more IPO, if there are more firms traded in the market than yesterday, why do you think it is related to investor sentiment? Why? You learned IPO already, right? So if firms do IPO a lot, do you think it is a signal for high sentiment or low sentiment? Any thought? Yeah, HYCO, any thought? High sentiment? Why? I think that is right. When people do IPO a lot, it means that there is high sentiment. Why? That's a good point. Yeah, that's right. So IPO means that we want to sell new stock. And then, I mean, we sell stock because we need funding for investment. And through IPO, we want to sell stock at high price than low price, right? So suppose, let's assume that you are all entrepreneurs. You have your own firm. You are businessmen. And then you want to sell your stock. When do you think you want to sell stock? When people are happy or people are unhappy? People are happy, right? When people are unhappy, do you really want to sell your stock to them? No, they won't be that interested. They have their own problem now. But when people feel high, then you want to sell stock because now people are in the mood for gambling, right? So, although IPO number of firms listed in stock market is not, they are not directly sentiment, investor sentiment, but we can conjecture that they are related with the investor sentiment, right? So that is one. Second one is called implied volatility. Well, that is a bit difficult concept. It's like we in Korea we have VIX. In United States there is an index called VIX, V-I-X, VIX. Okay, and it is implied volatility, and implied volatility is overvaluation of the options derivative. When implied volatility is high, it means that derivatives are like overvalued. Then why? Why do you think derivatives are overvalued when people are feel good? Why is that? For example, call option. Why call options are overvalued, for example, when people are happy? Yes, exactly. So let's think about the nature of the call option. Call option is that it is a contract we can buy some stock at some specified price. Like if we buy IBM call option, for example, like IBM Google call option, then maybe we can buy it is Google call option is something like this. We can buy Google stock sometime later in the future, not right now. We can buy. This is called expiration date. Sometime in the future of expiration date, we have the right to buy Google stock at $1,000, something like that, right? People will buy those contracts only when they feel optimistic, right? If you are not optimistic about Google or stock market, why do you want to buy stock that buy the right to buy a stock, right? Therefore, yeah, this implied volatility, which is one measure of the valuation of a derivative contract, that may capture people's sentiment about their future. Okay? How much they are optimistic about the future, something like that. Okay. Any question? I think this is enough for today, and then we can continue. Let me check this one. So we discussed up to this point. And then we talked about implied volatility. And anyway, I think this is the very important topic. So do you have any question about today's topic? It is not difficult at all, right? It's easy. Okay? It's very intuitive and all about common sense, easily. So anyway, if you have a question about this one, please ask me anytime. Okay? And thank you, and see you next Wednesday. Thank you.